Hey, welcome back. Today we'll talk about how you can access the cash that has built in your cash value life insurance. Our focus being participating whole life and index universal life. Let's get started. I want to start here with a small presentation in which we will review how cash actually accumulates in a policy. We will try to see what will happen if you decide to withdraw versus taking a loan. And we'll also see that there are multiple types of loans. So we'll try to keep it very simple. For that reason, we'll just look at illustration from an index universal life policy. Let's start by understanding again how the cash actually builds in a policy, depending on whether you use whole life or index universal life. Everything starts here with our policy owner. The policy owner agrees to pay premiums according to a specific schedule. Depending on the type of policy that you use, it's possible that there will be some fees, usually called a premium load, that will be taken out of the premium that you pay. You will then be left with the net premium. The net premium is actually the starting point. So if you go with a participating whole life policy, the growth in your cash value comes from two things. The very first thing is the guaranteed growth rate that you'll get every year, regardless of what happens, as long as the contract is in force. And on top of that, you will get dividends. Now, if you use a traditional whole life policy, you will not get the dividends. That's why it's important to use a participating whole life policy. Why? Because these companies are mutual companies, and by getting a life insurance contract, you become owner of the company. As a result, you participate to the profit of the company through dividends. The top companies that we typically work with have been in business for more than 100 years, some of them more than 150 years. And since that time, they have always paid dividend through world wars, depressions, and so on. But remember, it's not guaranteed. If you decide to go with an index universal life product, IUL, the growth in your cash value comes from two things. The very first thing, probably the most important, is an index that is attached to the stock market. Keep in mind that the index usually is limited by a cap. What does that mean? For instance, if you track the growth on the S&P 500, which represents the 500 top companies in the United States of America, let's say that year the S&P 500 grew by 20%. If you have an insurance contract that has a cap set at 12%, you will only get 12% of the growth, even though the actual S&P 500 grew by 20%. So the growth will go up to a maximum of 12%. Also, you have the participation rate. It simply means you participate to the growth up to a certain percentage. For instance, let's say I have an insurance contract in which I'm tracking the S&P 500 growth. And let's say that year, the S&P 500 grew by 10%. If my participation rate is 90%, then I don't get the full 10%. I just get 90% of that 10% growth. So those two features set how much growth you will get out of the performance of an index. In addition to the growth that you get out of the index, you also have the fixed account. The fixed account typically allows you to grow your cash at a rate that you will know, and the insurance company can change that rate every year. So now that you have your different vehicles that allow your cash to grow, you get to the accumulated cash. The question becomes, how do I access that cash? You have two ways. Either you go through a loan or you go through a withdrawal. This raises a few questions. What is the difference between a loan and a withdrawal? Another one, in what situation would it be better to do a loan or to do a withdrawal? And a more fundamental one, why in the world should I even take a loan in the first place? The cash value is supposed to be mine, so why will I take a loan out of my own money? It doesn't make any sense. We'll try to break it down, and hopefully it will make sense to you. To start understanding the difference between a loan and a withdrawal, let's try to break it down and see how each of them work. Let's start with a withdrawal, because this one is familiar to everyone that has a bank account. So we have here our life insurance company that has our life insurance contract. And here we have a small treasure box. That treasure box contains our cash value, the equity that has built in our policy over the years as we earn interest and pay premiums. Let's say we have a cash value of $15,000 and we need to take $10,000 to do something. It could be investing in the stock market, taking vacation, or making a major purchase, or whatever it is. So just like what you do in your bank account, you just take the money out. That's it. That's a withdrawal. That's the closest to what you've been doing with your bank account. However, remember this. A life insurance company is not a bank, which means you cannot just walk in swipe your debit card and get out with the cash. No, that's not how it works. You have to submit a request. And because you submit a request, it could take a few business days before you get the money in your bank account or you get a check through your mail. So it's not as fast as taking the money out of a bank account. Then, how is that different from a loan? Let's do another picture here. Once again, we have our policy owner. We have our life insurance company, and here's something interesting. We have the insurance contract and our treasury box that holds our cash value. But the insurance company also has its own treasury box that represents its cash reserve. Why? Because they have to respond to their insurance needs. So what happens in the case of the loan? When I need my $10,000 out of my $15,000 that I have in my cash value, I borrow the money from the cash reserve of the insurance company. Insurance companies can give you the loan because they know they will get their money back one way or the other. First of all, that money is collateralized by your cash value. So you will never be able to take a loan that is bigger than your cash value. In the event you pass away before you pay that money back, your beneficiaries will get your death benefit minus the outstanding loan. If you decide to cancel your policy, guess what happens? You get the cash value that you have minus the outstanding loan. As a result, the insurance company is not losing. In addition, you will be charged a simple interest that is paid once per year at the policy anniversary. As you see, it's a win-win situation. You get to access the cash, do whatever you want with it. The insurance company knows that either you pay back the loan, you pay interest, or if you don't pay it, the day you pass away, they get their money back by subtracting the death benefit minus the outstanding loan. Or if you cancel the policy, you surrender the policy, they still return to you the cash value minus the outstanding loans. This introduced a few important concepts. Learning how to use other people's money, because now when you take a loan from the insurance company, your money is not touched. It's still there in your policy, meaning that it can still grow and earn interest. But you get to use someone else's money to do whatever you need to do. Another very important thing is your cash value keeps growing, so it's not interrupted. You don't interrupt the compounding. And the final thing is you'll be charged interest. So you need to keep an eye on that, but it might not be that bad. When you have an outstanding balance in your credit card, how much interest are you paying? Minimum 21%. If you take a loan on your car with the current interest rate, how much are you paying? Probably in the range of 7%, right? But some insurance companies can give you a loan around 2% or 4% or 5%. So your life insurance can become a line of credit for you. And you can decide to use it whenever it's the right time. You have to make that determination. Now I want to show you the insurance company, they don't mind giving loans. Actually, they will not even do all the approval process that you will typically have in a bank. So let's look at the investment portfolio of two major insurance companies. Let's start with Guardian. Among other things, Guardian is in the business of whole life insurance. As you can see, the rating is A++. The report that was made publicly available back on December 31st, 2023, states that 7% of the investment asset comes from policy loans. So it's actually profitable for the insurance company to give loans because they make money out of it. And you can see that for Guardian, as of December 31st, 2023, giving loan was actually the third source of income for the company. Let's look at another one, Pacific Life. Among other things, they do business in the index universal life space. And one more time, you can see that 5% of the investment portfolio comes from policy loans, which is the third or fourth asset that they have in their investment portfolio. And you can also see that they are A+. By the way, Guardian has been in business for 165 years, considering the time I'm recording this episode. And Pacific Life has been in business for 157 years. So what does it mean to be an A++ or A+ company? It just means the company has a superior ability to meet ongoing insurance obligations. They are very strong life insurance companies. Is it possible that they go bankrupt? Yes, everything is possible. But the likelihood of that happening is very small because these companies are very strong companies. If they have been in business for more than 150 years, we tend to believe that they can stay around for a longer time because they know how to sustain the test of time. Now I want to show a screenshot from one of my life insurance contracts. Here you can see that I have an outstanding loan of 2983.83. You can also see that the policy anniversary is November 4th, 2025, and the charge interest is 4.76. So my question to you is, do you get any credit card that can give you this amount of money at this rate? Nope. You could have 18 months, 21 months, or some time during which you don't pay anything, and then after that, you are hit with 21, 22, 23, up to sometime 29% interest. So you see, I use my life insurance as my own personal line of credit. Depending on what I want to do, I will evaluate what is my best option. Maybe it will be taking a loan from a bank, or in this case, I decided to take the money out of my life insurance policy. If I don't pay this amount of money by November 4th, what will happen? My new outstanding loan balance will be this amount of money plus this amount. So meaning that from the next year, after my policy anniversary, I will have a larger loan balance. But guess what? I don't have to pay it back. If I don't pay it back, obviously it will keep growing. But if I pass away, my beneficiaries will get the death benefit minus the outstanding loan. So you see, it can become a loan where you don't have the pressure to pay back, and it doesn't show on my credit score. So it could be a good option. Now, before we go to the spreadsheet, it's very important to understand the power of uninterrupted compounding if you want to understand why it will be wise to take loans sometime. So as an illustration, just imagine that you were given 1 cent and that doubles every day, and you have to wait 30 days before you take the money out. By the time you get to day 30, you have a little bit over 5.3 million, which is a nice number. So you see the power of compounding. You can also see that probably for the first 24 days, it's not that funny. But once you get above $100,000, anytime you compound, you just grow a lot faster. Let's say we withdraw $10,000 on day 23. So you see, at the end of day 30, you are now just above 4 million. So basically, you lost almost 1.3 million by taking out $10,000. As you can see, you took $10,000 out, but you also took 1.3 million out of your future. Why? Because you decided to withdraw. Maybe you will say, oh, that's not too bad, I still have 4 million. If you take $10,000 2 days earlier, instead of having 10,485.76, you are now left with 485.76. It's basically like you went back sometime between day 16 and 17. However, you don't have the same time compounding moving forward. You have to stop at day 30. As a result, day 30, you are left with 200,000, almost 250,000. You see the difference? That's what happens when you interrupt the compounding of your money. Just because you took 10,000 out here, you just gave up all the potential growth 10,000 could have given you in the future. That's why when it's time to decide between a loan and a withdrawal, you have to ask yourself the question, am I ready to lose all the future growth of the money that I need to take out? Or do I want that money to keep compounding? If you want to keep compounding, take a loan. If you're ready to give up the future growth, withdraw. That's the bottom line. And you can decide to never repay the loan, but you need to keep an eye on how much the outstanding balance is growing and what is the effect on your cash value. You must also be mindful of the type of insurance that you use. If you use a participating whole life, the contract is guaranteed to never lapse as long as you pay the required premium. But if you use an indexed universal life, that's not the case. You don't have that guarantee. Now, I want to make one last stop before we look at the spreadsheet. In general, in IUL products, you have two types of loans, fixed loan and indexed loan. Depending on the company you work with, the fixed loan could be called standard loan and the indexed loan could be called alternate loan. And also, make sure that you just read your insurance contract because not all life insurance contracts are equal. So even though two companies could have the fixed loan, the term of the loan could be different. First of all, let's start with the interest that is charged. Typically in fixed loan, the interest will be very small. is going to be in the range of 2.25 or 2.75, depending on the company. And it's a fixed rate that is charged usually annually at the policy anniversary. Some companies will charge it in advance, but if you repay the loan during the year, they will credit back the money that they took. When it comes down to index loan, the loan rate is typically variable. So it will vary usually between 4 to 6 or 7%. So you'll see that in the contract. And depending on the economic situation, the insurance company could raise the rate in that range or decrease it. What is the impact on the cash accumulation? Remember that in an index universal life, the primary vehicle to increase your cash value is the index that is tracking the performance of the stock market. As a result, that money is removed out of the index account. Therefore, you don't participate to the growth of the index. Typically, insurance companies that do IUL will do something like, hey, for the first few years, we will charge you 2.25, for instance, if you take a fixed loan, and we'll just credit you 2%. The story is different with an index loan. With an index loan, the money that is borrowed is not taken out of the index account. As a result, you still earn index performance. But remember, the loan rate is higher, usually between 4 to 6 or 7%, depending on the company. Let's say you take a loan at 5% and your index performs 10%. You have a spread of 5%, meaning that you grow more than what the interest rate charge for your loan is, which is good. But if you take a loan at 5% and that year the index performs at 2%, now you have a negative 3%. So as a guideline, you can think about things this way. You take a fixed loan if you want to be conservative, because you basically take the lowest risk on the loan, and you also know that you're giving up the potential growth. So you know that you have an opportunity cost, but because you're conservative, you're fine with that. Okay. When it comes down to the index loan, you're trying to be more aggressive. You're trying to get the best of both worlds. You want to take the loan, but you also believe that the index will perform. However, if the index doesn't perform, you lose money. So it's your choice. Those are two different vehicles when it comes to loans that you can select to use, and you just have to understand the characteristics of each of them. Now that we have set this foundation, let's go ahead and look at the spreadsheet.